Hello and welcome to ET Market Smart Talk, where we decode complex market dynamics with India's top investment minds. Today we are focusing on a theme that's increasingly relevant in today's uncertain world, and that is building a balanced risk return profile in fixed income portfolios. Now, joining us today is Chirag Doshi, who's the Chief Investment Officer, Fixed Income at LGT Wealth, to help us understand how investors can navigate changing interest rate cycles while optimizing returns without taking any undue risk. Chirag, great to have you with us.
Thank you. Thank you for having me here and great to speak to you again.
Thank you so much for taking the time out, Chirag. And let's understand from you how can investors, sort of construct a fixed income portfolio that achieves a more balanced, risk return profile, especially in today's evolving interest rate environment.
Yeah, I think in this environment, balance is everything, Kshitij. Investors should aim for a barbell strategy,
Okay,
combining short duration, high quality bonds for stability, with
right.
selective exposure to medium to long duration or even higher
Mhm.
yielding credits for that extra carry. Uh,
Okay.
the diversify by both maturity and credit quality,
Hmm.
and keep liquidity at the core and let carry, not timing, drive the returns.
Right. Right. Absolutely. And what's the key sort of principles or framework investors can sort of use to balance yield opportunities with credit and duration risk in their bond portfolios?
See, think of it as a three-pillar framework. So, quality,
Okay.
duration, and diversification. So,
Hmm.
first, know who you are lending to. Second,
Okay.
define your duration stance. And third,
Right.
ensure that diversification across issuers and maturities is there.
Hmm.
Remember, yield is what you earn, but risk is
Hmm.
what you carry. So, the best
Yeah.
portfolios deliver consistent returns and not just the higher ones.
Absolutely. Yield is what you earn and risk is what you carry. Very nice on that, Chirag. And let's talk about a little bit on the macroeconomic side and, what macroeconomic conditions typically create a favorable backdrop for bond markets, particularly in emerging economies like India.
See, bonds across the globe and especially in India love one thing above all, and that is stability. So,
Okay.
the ideal setup is moderating inflation, steady growth, and a
Hmm.
credible central bank, right?
Right.
Now, when inflation expectations are anchored and fiscal discipline holds firm, bond yields tend to drift lower. And for India, contained inflation and strong liquidity create a favorable
Mhm.
backdrop, which we are currently
Okay.
experiencing.
Absolutely. And sort of how does investing in long duration government securities add, sort of convexity in a bond portfolio?
So, Kshitij, think of convexity as your portfolio's shock absorber, right? Long
Sure.
duration government bonds react more positively when rates fall, providing that non-linear upside in easing cycles. Now, holding some long duration government bonds adds convexity to your portfolio, which
Mhm.
cushions returns when yields drop sharply. So, you have that extra alpha that is generated in your portfolio when yields start easing, and that is what is expected from convexity.
Absolutely. And what might investors consider selective exposure to mid-rated corporate bonds, such as double A minus to A minus instead of or A negative, instead of sticking strictly to triple A rated issuers?
See, sometimes the market overpays for safety, and
Yeah.
that's why you see that the compression in the yields in the most liquid AAA sovereigns is
Sure.
quite fast. Now,
Hmm.
well chosen mid-rated credits can offer that 150 200 basis points of extra yield with controlled risk. So, if your
Okay.
selection is strong, and
Mhm.
it's about selectivity, not compromise, right? Focus on
Right.
issuers with improving balance sheets and visible cash flows. Now, in a
Hmm.
diversified portfolio, these names can boost carry and add that alpha without destabilizing the risk in your portfolio. So you have to
Okay.
be very careful with selection, and if done right,
Absolutely.
you can get that alpha which you may not be able to get in the full safe portfolios.
Right, absolutely. And in fact, if we talk about the US Fed, we just saw, slight bit of easing from the US Fed side recently. And in a scenario where global interest rates started to ease, how should investors sort of reposition within the fixed income spectrum here in India?
Very good question, Shadid. So, when rates start to ease globally, duration
Mhm.
becomes your friend, right?
Okay.
And gradually extending maturities to lock in yields before they fall
Mhm.
is what one should do. Keep core exposure in liquids because that
Mhm.
gives you nimble portfolios, and especially in the sovereign and PSU bonds. But add duration through longer dated government bonds or SDLs, which
Mhm.
basically give you the liquidity as well as the convexity that you would desire in a portfolio. Stay
Right.
disciplined. I think that's the theme. Easing
Mhm.
cycles can really be uneven, and especially in the global backdrop that we are in,
Right.
uncertainty and volatility is something that you have to live with. So maintain laddered maturities and
Mhm.
active oversight on these portfolios, because you can't just fill it, shut it, and forget it. You have to be constantly monitoring the portfolios and
Right.
ride the duration tailwind without losing
Mhm.
balance on credit risk. This will give
All right.
you foolproof
Mhm.
portfolios which will weather any kind of volatility.
Yep, absolutely. In fact, foolproof portfolios, that is something which we all are looking for. And on that note, Chirag, thank you for sharing your insights. And it's clear that balancing risk and return in fixed incomes is not just about, chasing yields, or it's about understanding as well the interplay between the credit quality, duration, and macro cycles, which Chirag beautifully, explained to us in this interview. And for our viewers, remember, fixed income isn't just the defensive part of your portfolio anymore. It can be a powerful tool for steady, risk adjusted growth when managed with discipline and foresight. Thank you so much for your time, Chirag.
Thank you, Kshitij. Pleasure speaking to you.
Thanks so much.